In this episode of On the Tape, I welcome Herb Greenberg, financial journalist for over 50 years. He's been writing about Wall Street companies, shorts, longs. Started his career, he wanted to be a disc jockey, but he turned into a stock jockey. We go down memory lane of some of his best ideas, some experience that he's had that led him to where he is today, and most importantly, some actual ideas both on the short and the long side. So enjoy my chat with Herb Greenberg. Welcome to the On the Tape podcast. I'm your host, Danny Moses. Today, it's an honor to have the Woodward and Bernstein of Wall Street with us today. Herb Greenberg, welcome to On the Tape.
Hey, really thrilled to be here, Danny.
So you're a prolific writer, and we'll get into your current passion, which is penning the On the Street, aka Herb on the Street, and your Red Flag Alert. We'll get into some of those current names there as well. But first, so you wanted to be a disc jockey, but you let Howard Stern do that at the time, around the same time period, obviously. So I always think it's important to understand what kind of makes people who they are, and kind of the journey that you went on. And I know, amazingly, there was a stop in Boca Raton, which I live in now. So that in and of itself is interesting. So give us a quick overview of how you got to where you're sitting right now, Herb.
The very quick overview is that I grew up in Miami, and the last thing I wanted to do is be a business journalist. I didn't even want to be a journalist. Yes, I wanted to be a disc jockey. I went to Miami-Dade Community College, which it was called back then, for my first 2 years, and subsequently to the University of Miami, where I got a scholarship from the Miami Herald. But what happened was the community college, they said, you have to get on a career course. And I said, well, what path? And they said, what do you want to do? I said, I want to be a disc jockey. Remember, this is way back, right, when radio was king. And they said, well, you have to take journalism classes. I said, journalism classes? I don't want to take journalism classes. But you got to take them. So I took a journalism class and actually loved it. I had an advisor who had probably groomed many of the journalists in Miami from her days at Miami High School and way back. And she just took me under her wings. And before long, I was just immersed in this concept of becoming a journalist and becoming a reporter and going to work during one semester. I worked, or longer than that, I worked mornings at the Miami News as a copy boy, the defunct Miami News as a copy boy. And then went to school in the afternoon. So I worked pretty hard at it. And so I just sort of naturally got into it. Now, when I graduated from school, because Knight Ridder, which owned the Miami Herald, had helped me get a job, it helped me, had been around. They owned the Boca Raton News, which no longer exists. And so they suggested I go to Boca Raton and look for a job. And so I did. And I wasn't good enough to be hired at the Miami Herald, and I understood that. Went to Boca. Boca in those days was a very small but growing place. Think about this. This was the Woodward and Bernstein days. Everybody in that newspaper wanted to be a political reporter. One thing I did not like doing is I did not like covering the Parks and Recreation Department, which I had to do. So what I did was they tossed around the newsroom once a week. Somebody had to take the business pages, had to do the business pages. It was a Saturday, Sunday deal. So when it was my turn, first time I worked there, I said, hey, I'll do that. I went and interviewed a guy at the manager of the public store, the local public store, which is a supermarket chain. And it was a fascinating story about how he rose from being a bag boy to being a manager. And in those days, they got profit sharing, and it was actually pretty interesting. For some reason, I just got hooked on it. And then just started doing the interviews because, Boca Raton, people came through Boca Raton because of the Boca Raton Hotel and Club, which was the place back then for conventions and things. And I used to interview these people, and Lee Iacocca lived down there. I did an interview with Lee Iacocca at one point just because he lived there. And I just started doing these interviews. And I was green, and I was learning as I went. And most of them were thumbsuckers. They weren't really hard hitting, obviously. There were features, but I enjoyed it. And the rest is I just slowly moved up the chain and ended up where I am now.
Well, I think you had a big impact. I believe the arbitrage firm you worked for, you saw the 1987 crash. And I think seeing that, and then I believe, correct me if I'm wrong, you went out to San Francisco soon after that. So I think it really, there's moments in time in people's career that sticks with you. And it's almost like an Outliers type Malcolm Gladwell story where you see certain things, you're able to express it. So that to me, when I was reading, the history, but let me fast forward to when you worked at the Street, and you were writing, because whatever Herb Greenberg was saying at the time, you were moving markets and you were moving names. And I remember, and I think you referenced this before, that people would have to get faxed some of the stuff that you were doing like live because you couldn't find it. But stocks are moving like, who's that? The Greenberg guy just wrote about something again. So tell me about that iteration, because I think you were there several years and kind of evolved, but you were one of the original kind of beat writers.
Well, that all started at the San Francisco Chronicle before I went to the street.com, because when I went to the Chronicle, I had worked at the arbitrage firm, and the arbitrage firm, I was a fish out of water there. I was a journalist, but the guys who ran the firm were sources of mine. They offered me a chance to come in. I realized pretty quickly that it wasn't quite what I wanted to do. It was but there I was, put on a position, learn how to do that, be involved in arbitrage back then, which was early activist investing. But come the crash, that was a scary time in 1987. And I remember walking out in Nassau Street and people were just looking glum. And I had a financial accounting course that night that I was going to, and it was canceled. And I looked around, and what had happened is the Chronicle had offered me a job. A friend of mine who I used to work with at the Chicago Tribune, went to the San Francisco Chronicle. This is the way the world works. He'd come to me and offered me a job to become a columnist at the San Francisco Chronicle for 6-day-a-week column. And at first I said, nah, I'm doing this. I have a chance to make some good money. I don't know that I want to go back to journalism. And then came the crash. And the night of the crash, I looked around. I thought there are many more qualified people than I am who would easily be able to take my job. I went home. I wasn't having that much fun anyway. I said to my wife, I said, I'm going to call Dan in San Francisco. That night, we had the time change, obviously. I called my friend that night and I said, hey, that job you called me about, is that still open? And I moved to San Francisco with the idea of creating a proprietary local column. And remember, these days, back then, the growth stocks were all coming out of San Francisco. We're talking about all the growth stock, the firms, Montgomery Securities, Robbie Stevens. That was the heart of it. You're just down the road from Sand Hill Road. This is where it was all happening. And so I came in originally doing some takeover speculation, trying to do something different. And then I just morphed into saying, hey, look, I met the Feshbach brothers who were a short selling firm back then. I said to myself, wait a second now. Everybody wants to write the positive stuff. I'm a cautious guy to begin with. Maybe I ought to write the other side of the story. And I just sort of went that route, started talking to the short sellers and folks like that, and had my own, but it was mixed because I talked to money managers, the best money managers of the time. Sometimes I just quote them about the stocks they liked, but I also had this edge, and I sort of honed my edge in those years. And Jim Cramer's the one who will tell the story that he would have my column faxed to him from his Morgan Stanley broker. I think it was Morgan Stanley broker every day, because I was having that kind of an impact, because people would come to San Francisco for the Montgomery Securities Conference or whatever it might have been, and they would see the column, and I just sort of got that cachet, but it was a regional cachet. And, it was there before CNBC. I remember when David Faber went to CNBC, I'd watch him come on the air, and as competitive as I am, I used to say, oh my gosh, please don't come on and talk about something I'm working on. I mean, that's how silly it was. I really thought he might be in the same circles, and thankfully he never did. But I just kept with that competitive edge, trying to build it, hone it, and that became ultimately what got me on the path I'm on right now.
That was called Business Insider, if I'm not mistaken. And the irony in that is that you were covering, as you mentioned before, Silicon Valley before it was even incarnated, and then you got to see the demise. But Henry Blodgett ends up buying the Business Insider name. Think about the irony in that, right? He was right in the middle
I remember. Let me tell you something.
Yeah.
I wanted to buy the Business Insider name because early on I had a site on America Online. In the old days, I called it Biz Insider. That's when they paid us to be content providers. And I think Jim got the idea of the street somewhat from what I was doing with that, which I obviously didn't have the capability of really building it and doing what Jim wanted. But I've said to Henry, I've said, I am the original Business Insider, so don't you ever forget that. But the Chronicle would not sell it back in those days, and so I was out of luck.
So what is the role now these days of financial journalists, investigators, just financial media? It's very democratized in terms of access to information, but How do you set yourself apart? And do you think there's a right now what we're seeing with I'm not going to get into politics here, but what we're seeing, there could be some fear of retribution just if people go after certain companies or certain people and how much that's changed. And you've always maintained your independence, and I'm sure you'll never change who you are. But talk to me a little bit about the landscape and the opportunity now for people that want to be a little bit more kind of bespoke.
Well, I think it's certainly harder on one hand. On the other hand, it's easier because that's where things are going. The world has certainly changed. You can date it back to the evolution of blogs, and when short sellers, I would say, would cut out the middleman and have their own blogs, and other people would just go direct. I think that, but if you look at what's happening today, I mean, if you go back to the days of, there was a big controversy years ago, and I was smack in the middle of it with Overstock.com and their CEO. And he went after people like me and everybody else on Wall Street. Back then, that didn't get very far because that was before social media quite is what it is today. In today's world, someone like that would have probably would have had a very different impact on just the perception of what he was trying to say. He had his own blog to try to discredit the journalists and the hedge fund managers and the short sellers and all those kind of people. But the difference between then and now, because social media is what really turned it, because now the media doesn't mean what it did. You didn't turn to the media. You don't need my column that was in San Francisco or what I wrote at thestreet.com in those wonderful years when the street was evolutionary and was revolutionary in the way it was approaching business journalism, no holds barred in many ways. That today is everywhere because there's so much content. Anyone can do it. Look at you. You have a podcast. Anyone can go out, and if they have a voice and they know how to write, and if they know how to do it, can get edge. But I can tell you, as a guy who's been doing this for over 50 years, that today it's a lot harder to do because there are so many voices. And do you want to be a polarizing figure? And what path are you going to take to be heard? Which is something I'm wrestling with right now. I'm making some changes as a result of that, because you have to think through that. But you also, in terms of the concerns of retribution, when you're on your own, you don't have the backing of a big newspaper or publication or broadcasting organization with their lawyers and their libel coverage. It's like, let me tell you something. For a brief moment, for a Scaramucci minute, as they might say, I tried to become an activist short seller. I thought I would. Stupidest thing I could have ever done. But it's like those things in life. You only live once. Just what do you know? And in 3 months, I was out of there. But before I did it, think about what I had to do. Put cameras in my house. Wonder what's going to happen to my assets. And I had to try to get libel insurance. Getting libel insurance? Oh my gosh, I may have been one of the last guys to possibly get a policy that possibly would have covered me at a somewhat reasonable price because of just the fears that anyone could sort of try to drive you out of business. So I think that that's one thing people haven't thought of, because when we were journalists, one thing you'd never do is you never call a company a fraud. I mean, I'd never outright, there's an allegation until it's proven. Today, the activists, short sellers will say, hey, this thing's a fraud. And to a guy like me, it's like, ooh, I would never say that. So, it's certainly a different environment than it was, and it's much more difficult.
Well, you mentioned anyone with a microphone and a pen can publish things, but I would tell you another difference is anyone can trade now. I mean, the access to trading, and you can call that great. I think it's fair. I think it's wonderful. But the immediate gratification of the markets, and when you're writing short reports, and by the way, you write long reports too. I just want people to understand that out there. You have some gems. And I always love when people who love shorting find something long. I think it's always figure that's been combed through already. But it's really to your point about being vilified and reputation and things. Those are the things you have to be concerned about, because short sellers and short reporters are always early by nature. If you weren't early, there's no story to it. So talk a little bit about how you adapt to the trading environment and algorithms and how they pick up certain things. And that's part of the game now these days too, is how companies play with algorithms by saying certain words on earnings reports or things that they know will get. And we're going to get into some of your red flags here soon and what you look for, but give me an idea of that too.
Well, I think in terms of the changed environment, it's certainly, it's affected my network, is certainly, even though some of it's the same, is diminished and is not quite what it was. Because I think, I talk to people who are short stocks. I don't short stocks. And I've never shorted a share in my life. I own stocks, but I've never shorted stocks. But I talk to people who run their own money or are short sellers at funds. And I say, why do you do this? And some do it for the sport of it because they have to do it. They love it. It's in them. It's in their DNA. As writing cautionary things is in my DNA. But we all know, like, if I'm writing a story, even when I was with my research firm, when I had my my short bias research firm that I had co-founded, toward the end, I would say we'd look at a company, like I remember it was WD-40, and I'd say, but look at the passive investors in that thing. It's like 50%. What's the point? You really have to have something really crazy. Or if I'm looking at a Canadian company, which I looked at recently, wrote about, I look like a fool. But the first question when somebody mentioned the company to me was, what about those Canadian pension funds? Because we all know about those Canadian pension funds, when, what they will do to just support a company. And here now you look at something and I'll say, why is that stock doing something? And someone will explain to me, one of my members of my network will say, look at the pod shops. It's the passives. It's the whatever it is. It's the algorithms. So what you have to then have is something that that this is going to come undone, or there is going to be something people will care about. But what they care about today is very different than what they used to care about, and what could move a stock. And I'm trying to point out risk as opposed to moving the stock. But remember, back in the 90s, remember when Howard Schultz started Financial Shenanigans, when he started CFRA, which was a research firm focused exclusively on accounting, and an accounting metric could cause a stock to move. Something Howard put out that was totally accounting related. Well, not that may not happen again going forward, given some of the stuff going on, but it hasn't been the case for a year. Today, accounting is part of the story. It's maybe, points you in a direction, but it's not going to shake stock any more than an SEC, any more than the announcement of an SEC investigation, or even the announcement of a Justice Department investigation. None of that matters anymore until the company itself has to get up and fess up and say, hey, we're screwed.
I was about to say, I don't think any of that can happen anymore without the express written consent of the White House. There won't be any company that's going after, which, by the way, I asked this to Jim Chanos last week. I said, the approach to short selling, you got to deal with enough to figure out the fundamentals of a company. Now you got to worry about lack of enforcement. And eventually tide goes out and the story happens, but still. So you mentioned before, I think one of the things that has occurred, and you lived through the Quattrone era and saw it firsthand, the separation of research and banking. It's never been worse, as far as I'm concerned, at this exact moment. It is completely conflated upon itself. And the reason I say that is, to your point about how the market structure has changed, research analysts at the big Wall Street firms, for the most part, are paid for two things: get access to a management team that you can take on the road and bring to see a client, right? And then just don't screw up our investment banking relationships, because we might want to do a convert or an equity offering, M&A for this company. So that's kind of the backdrop. And you can look at the buy ratings, or 75% of all the ratings on the street, 23% are market weight, and then 2% are underweight, or something like that. Don't quote me on that. But therein lies the opportunity, I think, for research. And you make a point, which all of us short sellers do, is going away from conventional wisdom, trying to poke holes in a story, thinking away from the herd like you do. And I want to get into that right now and some of the things that you kind of look for. And so to me, the opportunity is great when you look at a stock that you think is a short, and there's 47 analysts that cover it with 47 buys. So talk a little bit about the first things you look at. We're going to get into the red flags in a second. First things you look at and how it's changed maybe since maybe lack of enforcement by the government.
Well, I think, I'm not generally looking at how many buys, or when I write something, I'm not looking at something like that, because I'm looking at something that grabs me. I'm looking for a story. I want to know if there's a real story here, and I want to know if something it stands out that I think some people will find an interest in. And it's really hard when you're writing, because you do need people to read your work. And so you have to make some judgment calls that something might just be so damn boring. But I recently had one of those that was so damn boring. It would turn out to be a great story, and I really enjoyed doing it. I look at this issue with banking. It's interesting you mentioned that, because I don't think about that at all. I don't even see it in my world. I'm not embroiled in that the way you are. I'll look at something, and if everyone has a buy on it, yeah, we all know that, you used to look for the one analyst that veered from the pack. But I don't think of that as much when I'm doing my work. I don't even look at it. It's just not a factor. But I always think it's kind of interesting because, the whole Sarbanes-Oxley, what you're talking about is very contradictory to the reality that ever since the church and state were supposed to have been separated, IPOs and that whole business fell apart. But here it is. We don't have IPOs, but these companies are absolutely, they're going into private equity. They're being sold to private equity. They're being done it with other deals. But no, I don't feel it. I don't feel what you're talking about.
But let me just say that in a different way. When I go to the horse track, the last thing I do is look at the odds first. I want to do the handicapping and then look up and say, wow, I love that this horse is 30-1. No one has seen maybe what I'm seeing. My point is this: when you start to do work, you do the work first, but you should be looking at short interest, and it should give you comfort that it's very low, which means that you're early. And my point about validation or not validation of using Wall Street just as a feedback loop, say, okay, there's buys on this. Obviously, if anyone saw what I'm seeing, they shouldn't have a buy on it. So what I'm saying is it can be a differentiator. I'm not saying that you should look at it first. I'm saying as part of the process, it's a great validation.
Well, yes, it is. And look, I genuinely, for better or for worse, tend to look for things other people aren't looking at. Every now and then I find myself in the middle of a battle, or if I have a new twist on something, I'll find myself embroiled in that. But one of the first questions I'll ask is, what's the short interest in that? Because if I'm not bringing value to the story, or the story's already been washed over 50 times, what's the point of me coming there? I want to be on something else. What I've learned is that Wall Street is so lazy in many regards that they really do want to go where their friends are. They really want to go where the crowd is because it gives them comfort. And I also found that, I was listening to Jim Chanos' interview you did last week, where he talked about the studies showing that high short interest names tend to do better. I'm not necessarily I'm not looking for a short the way you are. You and I are looking at we're looking at similar but different things. I'm looking at stocks that are likely to lag the market, that are likely to have higher risk, because my approach now, doing what I do, is there are thousands of companies out there. Why would you buy these? Because they have a little more hair than others. Because that's what, with the retail market, the changes in the Robinhood crowd, they all want to rush to those names. I'm even thinking about putting short squeeze ideas. Let me rephrase that list of companies that are high in short squeeze lists in my research, just because those are potentially some of the riskiest stocks out there. So, there's so many ways of looking at this, but just remember, I'm not looking at it as a short. I don't think that way. If there's lower short interest, I'm more likely to be interested in the idea or the story, because it means it's going to be new to people who are absolutely interested in hearing something they haven't heard before.
No, I love your strategy of helping people avoid. You say there's thousands of stocks you can choose from. Let me just tell you the ones that I would not put my money in on the long side. So Vinny Porter and myself at Seawolf Capital, we used to have a red flag. We actually had one of those NFL red flags that you would throw out when you want to, conduct some type of replay. And we would pick it up at various times. Three of us didn't know what the other one was working on, and throw it against the wall. And when it hit the wall, they say, what do you got? And it would be something that we would see, some red flag that went up. So you have a red flag alert, which I know is for your premium subscribers, and we're going to get to that in a little bit. But, accounting games and non-cash comp and goodwill. And before you get into that, I just want people to know that you were riding on Solar City and Tesla in 2013. Tesla specifically about, warranty reserves. You were talking about names like IBM and things like that. And we'll bring up Williams-Sonoma, which is a more recent one. But tell me what the red flags are that you are looking for that kind of make you the most nervous.
Well, the most nervous that I'm going to write about it, or that I'd be the most nervous if I were an investor. I mean,
let me phrase it. Most excited.
The most excited.
Yeah.
Well, I'm going to tell you something. I mean, look, I'm not trying to find the frauds, right? Because I think that if one happens to be one, or I see something, but I can look at, say, one that I just really feel horrible. I had to pull off my list because it checked every single box, was Yeti. Remember Yeti? That was the big short story many years ago. And then the stock went on to do really well. And I recently had a red flag that for every fundamental reason you could come across, The charts were just looking like this all the way along. It was a wonderful idea. No one had paid attention to it. I get excited about watching just the classic deceleration of business when you can get it, when you can find it. The negative of that for what I do is I'll always say the risk of that as being an idea of a short idea or not owning it as long is some activist is going to come along because Danny, you know this as well as I do, that the same screens a short seller will use are the same screens an activist, long activist investor will use. They'll often, assuming the balance sheet isn't so wacky, come at it to the same place. And at the last moment, I've had that happen so many times in my career where you have a great idea, but then somebody else comes along, makes a lot of noise, and the stock goes back up and they get acquired or whatever the case may be. So I don't know. I mean, I don't have a process like that. This sounds crazy. I don't have a checklist. I have the my list, which is just something I talk to. It may be something as simple as you're in my network because I get ideas from things I think about or see, but a lot of times it comes from the network. That's not changed over the years. And there's certain people in the network who I will stop all things for and just at least hear them out because they're that good. Their instincts are that good. Their radar is that good. And so I want to hear that. But then again, I've got to find something. I'm looking at my list right now, and there's so many different variables for each one of these names that grabbed my attention. And none of them are the same. It's just.
Can you walk through a couple of examples? And before you do that, some of the stuff that you've taught, I always talk about mind your Q's and K's. No one does this, but you read the 10 Q's and 10 K's, you can find out a lot, whether there's a litigation issue, whether there's some type of accounting. And I want also people to understand that when you see the word non-GAAP financial measure, that means that the auditor did not approve of it and they can actually wipe their hands clean, which is a whole nother issue. But Herb, correct me if I'm wrong, you have looked at defined accounting games. So I totally agree with you on a fundamental basis. Just because the stock looks expensive, it's not a great short thesis. To your point, you're fighting up potentially against an activist investor. But when you think someone's playing games with either accounting or goodwill, and even though it's legal, it's going to catch up with them because the fundamental valuation of the company is not what it appears. Those are two different things. And I'm not trying to force you to say that you have found tons of frauds and that's what you do, but you have written about that stuff in the past. So as you look at your kind of red flag alert right now, and maybe talk about a couple names that have caught your eye, if you wouldn't mind sharing those, I think that'd be great.
No, I mean, I'm looking at some right now that are on my, I have a focus list and I have my master list. I have 34 names on the master list, and I recently whittled it down to a focus list of ideas that I find fascinating. And by the way, I should say one other thing. You mentioned, with high PEs, there are those companies that people, we had it with our research firm. Newell was one of the best examples of that. Stock is absolutely crushed, and you now find some new stuff and you want to roll it out, and your subscribers go, stock's already compressed enough. Well, as we all know, what goes low is the old story. It went from 90 to 10, but from 10 to 1 is a big drop. So several that I've looked at that I like. I mean, Hims and Hers is the battleground that I'm involved in right now. It's been the battleground that I've written about. There are a variety of other people. There's another guy I know who's really been doing some really good work on it, who's public with it. But this is just a classic case where the underlying fundamentals are absolutely coming unglued. There's a tremendous amount of hype around the GLP-1s, which are going away for them. So you try to look at the Reddit crowd and the retail crowd that's piling into it for the wrong reason, and they're never going to do what one of my pals did, was to back into the numbers totally to find. He was very creative in doing this, to really see what's going on with the numbers the company won't give you. That always is, of course, it's a real skill. Not everybody has it. And so you look at that company and you watch, and you look at it even here, 27.30, wherever it is today, and you go, what's it doing here? What do these people expect? And I have to tell you another one. This has nothing to do with it. I've never, since the days of Molycorp, which went bankrupt, which is a rare earths company, and is now rechristened through a SPAC to be MP Materials, never paid attention to the company. Never. Too much of a battleground for me. But I was talking to somebody the other day, and I started looking at it. And the guy sends me, he shows me a CNBC interview with the CEO from about a week ago. And I watched the interview, and my jaw's on the ground, because what the guy is saying is, I said, is he a promoter? What's he saying here? What he's saying I'm not going to say it's not true. it's if you even take a look at the company and you look at an MP Materials, let's talk about it. I haven't written about it, but I'll talk about it because I spent some time on it over the past days, so it's fresh in my mind. And that is a very simple story here. The stock is up because of the rare earth issue where the China is going to ban rare earths from coming here, and people go, oh, that's going to be great for MP Materials. And then you go to MP Materials financial statement. It's fantastic. And in the financial statement, they say, where do they get 90% of their revenue or 80% of their revenue from? It's from selling product to one of their related parties in China. And so basically, if China is going to raise tariffs to 125%, they're kind of screwed. And then if you go through the filings, you see where in the filings they basically are telling you, they keep talking about how, the old boilerplate, this may have adverse effect. No, it not may. But then if you listen to the CEO on CNBC in his interview, he basically is saying, well, this could have near-term impact on us. He doesn't tell you what near-term is. And if you keep listening to this, then the host asked the question of, well, can you get out of this China jam? She didn't ask it quite that way. Can you do that easily? He goes, oh, yeah, it's going to be easy. And then if you listen to the story even more, if you listen to the interview, he talks about how it could be years for some of this to evolve. Anyway, you have a classic situation where you have a company with an aggressive CEO who is the founder, chairman, CEO, and one other thing. And you look at it and you say, there's an issue here that if I wanted to go through the geology of it and fully understand it, I think I would have a fantastic story. That certainly has me galvanized. And it has me galvanized, by the way. You ever see Mara Holdings? It's a Bitcoin miner. Well, Mara's on my list. It's on my focus list. And Mara has issued so much stock to handle its purchases of Bitcoin. That the beauty is they just put out another offering that they're going to put out more stock. If you look at the stock, the shares outstanding, they're going straight up. And what I find interesting is if you look at the company, I was looking back through the filings, and the company actually has as a business strategy that they put in place in the third quarter of last year, that HODL, hold on for dear life, is a business strategy. I went and I did a search of companies. Who else has hold on for dear life as part of its business strategy? They do. And to me, that's like, oh, it's begging me. It's begging me to want to come in. But of course, I already wrote about them because when they talked about using excess energy for shrimp farming, things like that are going to always get my attention and are going to, you see things that are way off a baseline.
Herb, I got good news and bad news. So you think about that Donald Trump just pardoned Trevor Milton, Nikola, right? It was complete fraud. Guess who the largest investor is in MP Materials? You think that company is going to get touched? I think Chamath is very involved. This is the point, though. If you think someone's overpromising or being a stock promoter, you got to look at their political alliances potentially, and take that into account, which should never be the case.
I agree with you, but it's not going to keep me from writing about it because you never know. And in the event of something with this thing where in fact, when I listened to this interview with the CEO of MP Materials, he was making a pitch to the Trump administration, not outwardly, but his words were all basically, that just playing to the theme. And you and I know that enough. We know spin, but the street wants to buy into it. The algorithms want to buy into it. Let them buy into it.
So some of the biggest things I look at are CFO leaving, general counsel leaving. Those to me are an automatic enter the bucket, take a look. Now, it could be nothing, could be a health issue, could be some of those are things that I obviously pay attention to. I know there are some longs that you like that you've talked about here, that you've written about recently. Maybe let's get to a few of those.
Well, I mean, the one I wrote about most recently as a potential long is Netgear, which I joke is a company everybody knows about, but nobody's thought much about for a long time. And Netgear is an interesting juncture right here because their biggest competitor is TP-Link, which is in the router business, consumer router business, and the business router business, which is a Chinese company in which sells, I think they have a 65% share of the market, TP-Link. Well, there's been a lot written lately, whether it's the Wall Street Journal, Bloomberg, investigations, like the U.S. government's looking at TP-Link on whether it poses a security risk to the United States, which is very interesting. And TP-Link's trying to distance itself from the Chinese entity. Bloomberg had a great piece on this a few days ago, by opening an office in California with, I think it's the brother of the founder, and there's a family split. Well, and I read this, and the first thing it reminds me of is a San Diego company called Too Simple, which was a Chinese autonomous trucking company, which didn't quite get nailed for having security issues, but let's just say it doesn't exist anymore. And it was one of the hottest IPOs in that space a few years ago. So Netgear actually could benefit from two things here. One thing it could benefit from is if TP-Link is somehow, whether it's through tariffs, this current investigation, that what they call the Section 232 investigation, if that does indeed impact routers, that could help them. The other thing is if it's banned because the government's investigating them for possible security issues because routers are in your computer, it's like the chips. And they're also going through a turnaround. They have new management, and the turnaround seems pretty interesting. New management seems pretty interesting. And what's interesting, when the stock was 14, an activist came in, I think the stock was around 14, an activist came in and said, oh, the stock should be double in the next 18 or 12 to 18 months. And the stock went up quite a bit, but it came back down, obviously, with all the stuff going on in the market. So I think, but the issue is I say this is a company with a catalyst and a fundamental backdrop that I think is worth paying attention to, because again, nobody else is paying attention to it, which makes it perfect for me.
I'd love to get your thoughts right now, just on the market in general, how you think about it, the construct of it, given the noise, and hopefully we get through all this tariff stuff. But it seems like we've damaged at least how people think about investing in the U.S. And as a trading partner, I won't try to go into what's going to happen to the U.S. dollar. I'm a gold bug, obviously, for part of that reason has been for years that at some point the dollar would potentially debase. But give me your thoughts on that. And then I had one other question about a particular industry that I think you'll find interesting.
I'm not a macro guy and I'm not a markets guy, but I certainly pay attention to the markets. And I think in talking to my network of people, the level of confusion is extraordinarily high. And the issue of how to deal with investing in the US obviously is a problem. Before any of this happened, when I talked to my friends in other countries who short stocks, it's interesting, they just stopped shorting US stocks. Many of them said, I don't want anything to do with US stocks anymore. And this is well before the tariff issue and the political issue, but more just because of the nature of the structure and the changed structure of the US markets. But as what we're going through right now, I think I'm no better than the next guy on the street on that one. And by the way, neither is anybody else.
That's a good point. All right, one particular industry I always like to see when retail investors start to get access to certain products, it's not, it may be the potential the end of that cycle. So over the last 4-6 months, we've seen kind of the advent of private credit now being shown to retail. What a wonderful opportunity for retail investors to start investing in private credit, right? And it tells you two things. I mean, it tells you, obviously, it's a very profitable engine for private equity, and they're doing nothing wrong by doing it. But you always got to question, obviously, it's a very high fee relative to ETFs and so forth, when that happens. And it tells me that the demand for the paper that they need to clear some form or fashion is not as prevalent as it was by some of the other institutions and pension funds that may be buying it. When you see something like that, because we've seen it all in various forms. You saw it in the mortgage sector at the time. All of a sudden, people getting access to invest in mortgages that weren't before. What are your thoughts on something like that? And private credit is such an important part of this economy now. I'm just curious if you have thoughts there on the product and on the sector.
Well, on private equity in general, and private credit is what you're talking about as opposed to private equity, but they're tied together. It is on one hand, it's a highly inefficient market, especially at the small cap level. And I've done some work on this. I've looked at it. I've spent some time researching it. And I think that even the people who know private equity, think about this. They have to be so careful with their own research if they're really serious about it so they don't get stuck. What I think is really going on is there's a logjam in private equity and private credit and private everything, where the funds that invested in many of these companies, especially the smaller companies as part of small private equity funds and small funds, they're stuck. And the private equity firms these people are telling their partners, their general partners, of the limited partners are telling the general partners, based on what I can discern, is we're not going to invest in any more money with you until you get us liquid in these names, because it's taking a lot longer. Companies are staying, they wanted to do either a strategic deal, there has to be an exit, strategic deal, IPO, whatever the case may be. They're not happening at the same pace. So you've got this dynamic going on, especially at the lower level in the private industry, which I bet you is feeding into this. And then private equity firm, or the Wall Street being Wall Street, where remember, those investment bankers that used to be part of making IPOs happen are also part of this whole ecosystem now. And what do we know about bankers? They are really creative at coming up with good products.
Well, it's a nice feeling for a retail investor when the market gets crushed, but hey, their private investments don't change, so they get to keep their NAVs, as they say, their marks where they are. So Herb, you're currently writing On the Street, which is, obviously is Herb on the Street, and the red flag, alerts which go up. And you've been doing this on Substack, but tell the listener and viewer where they can start to find it. Always at herbgreenberg.com, but maybe give us an update on.
I'm actually making a shift to a different platform, a smaller platform. What I've learned, I've been doing this now with a paid product for since August, and it's going okay. But Substack is Substack. It's a lot of people come there. It's easy to get subscribers, free subscribers, but conversions is another story. And I know I do extraordinarily good work, and I came to the conclusion that for a variety of reasons, I came to the conclusion that if you build it, even if it's great, they will not necessarily come. And I think you have to, in the end, the reality is you have to market. So I'm morphing to another platform that is, I think, extremely good at the marketing side, meaning email marketing, which is critically important to be heard to a group of people who want to hear it, as opposed to trying to just blanket it out there and hope it sticks with 1 or 2 or 3 people. So this is the process I'm currently in. We'll see if it works. It may or it may not. I can always, I'm going to keep my thing on Substack. I'm just not going to publish there anymore. Currently still publishing there as we report this, but that will change over the next few weeks. Substack's been a good place to start. It makes things so easy, but this is a business for me, and I need to find a way to continue to stop hearing people tell me, hey, I didn't know you were doing that. And I go, well, yeah. So, you've got to get the word out. And I know that my whole thing is about, beware of the risk. And if I go to my grave, and if it's on my tombstone, he said, beware of the risk. I once said, I don't want to be the grumpiest guy in the graveyard, but I don't mind being the guy who reminds you that you're going to die. So, that's my approach to this. And I think there's real value in that for people who want to listen.
Oh, people will come, Herb. They'll come to your website for reasons you can't even fathom. So listen, you're going to help people for years to come. Obviously, investors, you're not just a great investigative journalist, you're a great writer. And I think people enjoy reading your stuff. Go to herbgreenberg.com. And Herb, I can't thank you enough for coming on the podcast today.
This has been fantastic. Thank you for having me.